Hello everyone, my name is Gauri Kumar and my metric number is 312989. Today I will explain the concept of joint products. Joint products are products that are produced together from a single production process where one input produces multiple outputs at the same time. This is common in industries such as dairy and petroleum. The first characteristic is simultaneous production, meaning all products are created together in one process using the same materials and resources. The second characteristic is the split off point, which is the stage where the products become separately identifiable. Before this point, the products are combined, but after it, they can be separated and sold individually. For example, milk is separated into cream and skim milk. The third characteristic is the inseparability of costs. Before the split off point, all costs are called joint costs, such as materials, labor, and overhead. These costs cannot be traced to a single product and must be allocated later. Finally, joint products have high economic value, meaning each product has significant sales value compared to other outputs from the same process. In conclusion, joint products are multiple valuable outputs produced together in one process and separated at the split off point. Next, I will explain the difference between joint products and byproducts. Joint products are the main products produced from the same process and usually have a high sales value. Examples are gasoline and diesel from crude oil. Byproducts are secondary outputs with a lower sales value. They are not the main objective of production. An example is sawdust produced in a lumber mill. In accounting, joint costs are allocated to joint products, while byproducts usually receive little or no allocation of joint costs. Next, I'll be explaining about the importance of decision making. Joint cost allocation is important for decision making. First, it helps managers decide whether to sell a product immediately or process it further for additional profit. Second, it supports inventory valuation and profit analysis by showing the profitability of different products. Third, it helps with price regulation and ensures costs are allocated fairly. Finally, it supports long-term business planning and strategic decisions to improve profit.
Hi and a very good day to everyone. My name is Pechai Dylan and my matrix number is 313685 and I'm a member 2 for this presentation. So Gauri has just walked us through what joint products are, which is the definition, the characteristics and why they matter in decision making. Now I'm going to take you on a level deeper. I want to show you exactly how the joint production process works, which step by step, and what happens at each stage of production, and I'll be using Malaysia's rubber industry as my real world example throughout. So let's get started. Okay, so this slide shows the full picture of how joint production flows. Let me walk you through it from left to right. It starts here on the left with one raw material. In our case, raw latex. This latex enters one shared process called the joint process. Now, during this process, everything, the materials, the labor, the overhead, all of that becomes what we call joint cost. And the most important thing about joint cost is they share. You cannot say this cost belongs to product A or this cost belongs to product B. Not yet, because at this stage, all the products are still being produced together inside the same process. Then we reach the split off point right in the middle. This is where things start to change. After this point, each product becomes its own separate identifiable thing. Now look at what happens after the split off. Some products like product B here can be sold immediately, straight away, no extra work needed. But other products like product A and product C, they need a bit more processing before they are ready to sell. And those extra costs that come after the split off, we call them separable cost because they only belong to only one specific product, not shared anymore. So the simple takeaway from this slide, joint cost before the split off, separable cost after. That's the foundation of everything. Now, I want to zoom into split off point in detail because this is honestly the most critical moment in the entire production process. And I have broken it down into 3 stages. Look at the first column. Before the split off, at this stage, the manager has absolutely no choice at all. All rubber products are being produced together in one single process. The costs are joined, they are shared, and you simply cannot trace them to any one product yet. The manager just has to let the process run. Now, the middle column at the split off point. This is what I call the point of no return. This is where rubber products physically separate from each other and become individually identifiable for the very first time. And this becomes the most critical decision point because what happens next is now in the hands of the manager. And that brings up to the third column after the split off. Now, everything changed. The manager has a choice. Each product has its own separable cost and the manager must now decide, do we sell this product right now at this point, or do we spend more money, process it further and sell it at a higher price later? That decision is exactly what I'll show you in a few slides. Alright, now let's make this real. Let's talk about Malaysia's own rubber industry. It all starts here on the left, raw latex tapped directly from Hive Brasilien's rubber trees. This latex then enters a centrifuge and processing plant, and this is the joint process. One single shared operation. And from this one process, look at what comes out at the split off point. 3 joint products all emerging at the same time. Red smoke sheet, latex concentrate and rubber crumbs, also known as silk. You cannot choose to produce only one and skip the others. They all come out together from the same processes. That is the definition of joint production happening in real life. Now, for some context on how big this industry is, Malaysia is the world's 3rd largest rubber producer. We exported Rm 8 billion worth of rubber products in 2022 alone, and our major producing states, which is Perak, Negeri Sembilan and Johor, are all running this exact same joint production process every single day. And just to note, similar joint production processes also happen in other industries like palm oil, where CPO and palm kernel oil are produced together. Petroleum, where petrol, diesel and kerosene come from one refining processes, and dairy, where milk, cream and butter are produced simultaneously. But for today, rubber is our focus. So now, let me explain each of the 3 rubber joint products properly, what they are, where they go and what happens to them after the split off point. First, rib smoke sheet or RSS. This is rubber that is coagulated and then rolled into flat sheets, dried and smoked. Where does it go? Mainly into tires, industrial rubber goods and export markets. And because it needs that smoking and drying process after the split off, it is categorized as further processed. Second, latex concentrate. This is purified liquid latex separate through centrifuging. Now this one is very interesting. It actually has 2 options. It can be sold immediately right at the split off point, or it can go through further processing to become medical grade latex, which sells at a much higher price. And you'll see exactly how that decision is made in my next slide. Third, standard Malaysian rubber, also called SMR or SIR. These are technically graded rubber blocks used in car tires, rubber parts and engineering applications. This product goes through crumbing and balling before it reaches the customer. 3 different products, 1 process, same raw material. That is joint production in Malaysia's rubber industry. Okay, this is where management accounting really comes in, and this slide shows one of the most important decisions a manager has to make after the split off point. The decision rule, and I want everyone to remember this: you process further only if the extra revenue you earn is more than the extra cost you spend. If it's not worth it financially, you sell at split off and stop them. Let me show you this using latex concentrate as the example, because as I mentioned this product as a choice. We sell latex concentrate right at the split off point, we get Rm 3.20 per kilogram. Simple, done, sold. But if we take that same latex concentrate and send it through further purification and sterilization to make it into medical grade latex, we can now sell it for Rm 4.50 per kilogram. That's Rm 1.30 extra revenue per kilogram. That extra processing cost us Rm 0.85 per kilogram in separable cost. So when we do the math, Rm 1.30 minus Rm 0.85, we get a net gain of Rm 0.45 per kilogram. So what's the decision? Process further. It is profitable. The extra revenue beats the extra cost. Now, here's one really important accounting concept I want to highlight. See this note here on the right. The joint costs that we already spent before the split off point, they are completely irrelevant to this decision. They are sunk costs. They are already gone. We cannot get them back. So we never look backwards. We only evaluate what happens after the split off when making this call. That is a key principle in management accounting. Right, let me bring everything together before I end over. Number 1, joint production means one raw latex goes through one processes and give us 3 products simultaneously. You have no choice, they all come out together. Number 2, the split off point is where RSS, latex concentrate and SMR become individually identifiable for the first time. That is the most critical moment in the process. Number 3, before the split off, all costs are joined and shared. After the split off, each product carries its own separable cost. Number 4, the sell or process further decision follows one simple rule. Process further only if extra revenue is greater than separable cost. We saw this with latex concentrate. A net gain of 0.45 per kilogram made it a clear decision to process further. And number 5, Malaysia's rubber industry is a world-class, real-life example of joint production happening right here at home, contributing Rm 18 billion in exports. So that covers everything on the production process side. But now that we understand how joint production works and how the flow operates, the next natural question is, how do we fairly allocate those joint costs to each product? How much of the shared cost belongs to RSS? How much to latex concentrate? How much to SMR? That is exactly what member 3 is going to explain right now with the cost allocation methods. That's all from me. Thank you very much.
Assalamualaikum and hi. My name is Nurliana Izzati bint Nazrin, metric number 314125. I will be presenting my part which covers the cost allocation method. For this topic, my reference is based on an industrial article titled Joint Product Costing published by Maxwell CPA Review. Okay, before we dive into the calculations, let's first look at why joint product costing is essential for businesses. There are several core purposes. First, it helps calculate accurate unit cost for inventory valuation. Second, it is essential for determining the exact gross profit of each specific product line. And the last one is, it assists management in making decisions, whether to sell a product immediately at the split-off point or process it further for a higher market value. As shown here, you can see the 3 primary allocation methods that I am going to explain, which are the volume method, the sales price at split-off method, and the net realizable value method. Now, let's begin with the first method, which is the volume method, or also known as physical measure method. Under this approach, joint costs are allocated based on the physical quantity or weight of the products at the split-off point. Okay, looking at our diagram, let's say our facility is processing a tree with a total joint cost of $5,000. Once it passes the split-off point, it simultaneously produces 2 items: lumber weighing 5,000 pounds and firewood with a weight of 1,000 pounds, making a total physical weight of 6,000 pounds. For lumber, its physical share is roughly 83%. So, multiplying this 83% by our $5,000 joint cost gives lumber a cost allocation of $4,150. Meanwhile, for firewood, it represents 70% of the total weight. So, it absorbs a cost allocation of $850. Let's move on to the second method, the sales price at split-off method. Okay, this method is widely considered the fairest and most popular because it allocates joint costs based on the relative market value of the products right at the moment they separate. Using the same example with a $5,000 joint cost, we can see that at the split-off point, lumber can be sold immediately for a market value of $12,000, while firewood can be sold for $2,000. This brings the total sales value at split off to $14,000. Okay. In terms of revenue proportion, lumber contributes 86% of the total value. When we multiply 86% by our $5,000 joint cost, lumber is allocated $4,300. On the other hand, firewood only contributes 14% of the value, so it bears a lower cost allocation of $700. Finally, we have the net realizable value method. This specific method is used when joint products cannot be sold directly at the split-off point because they require further processing to become marketable. Okay, as shown in this diagram, our initial joint cost is still $5,000. However, after the split-off point, both products incur extra costs for further processing. Okay, for lumber, it requires an additional of $2,000, while firewood requires an additional of $400. After being fully processed, lumber is eventually sold at a final price of $20,000. To find its net realizable value, we deduct the extra processing cost from the final selling price, giving lumber and net realizable value of $18,000. For firewood, the final sales price is $3,500. After subtracting its $400 extra cost, firewood's net realizable value is $3,100. Combining both numbers gives us a total net realizable value of $21,100. Okay, based on this ratio, lumber holds 85% of the total net value while firewood holds 15%. To conclude the calculation, we allocate our original $5,000 joint cost using these net realizable value percentages. For lumber, it is allocated $4,250 and firewood received $750. And that concludes my part on the cost allocation methods. I will now pass to my teammate for the next section. Thank you.
Good day. My name is Mohishri. My matrix number is 313707. And for my segment today, I will be presenting an in-depth analysis of a journal article titled Joint Products CVP Analysis, Time for Methodical Review by N.E. Patrick N.E., published in the Journal of Economics and Business in 2019. I will also be connecting this research to a very familiar Malaysian context, our very own palm oil industry. First, I will talk about the background and research gap. To understand why this article matters, we first need to appreciate the challenge it addresses. In any business that produces multiple products simultaneously, which we call it joint products, managers need to plan profits accurately. They do this using a tool called Cost Volume Profit Analysis or CVP analysis. Now, the most widely used method for multi-product CVP analysis is the Weighted Contribution Margin method or WCM. This method has been taught and applied for decades. However, NE 2019 identified a critical flaw in this method. He argued that the WCM ignores an important relationship, specifically that a product with a higher profit margin will reach its break-even point faster than a product with lower margin. By ignoring this, the WCM produces inaccurate results that can mislead management decisions. This figure shows the trade-off between CMR and BEP graph. As you can see in this chart, which was taken directly from the article itself, as the contribution margin ratio increases, that is shown in the blue line, the break-even point decreases, shown in the yellow line. This inverse relationship is exactly what the WCM fails to account for. Next, the methodology. To test his hypothesis, Enge collected real operational data from a confectionery company and a bakery firm, analyzing 6 joint products over 42 weeks. He then compared two methods side by side, the existing WCM method and his proposed alternative, which is the reverse contribution margin ratio, or known as RCMR, which he originally introduced in 2012. He used OLS regression analysis to statistically test which method was more accurate. This is the actual data used in the study. 6 products from real company with their sales quantities, selling prices, variable costs, and their contribution margins. Now, I will talk about the key findings. The results were striking. Using the WCM method, the computed break-even point came to $1,154,280, meaning the company would need to generate over $1 million in sales just to break even. But using the RCMR method, the break-even point was only $1,064,853, a difference over $89,000. Even more telling, when both methods were tested against a profit target of $75,000, the WCM overshot the target by a massive $96,119. The RCMR, on the other hand, only missed the target by just $16, which is most likely due to rounding. These profit figures are took from the comparative income statement from the article. You can see it clearly here. The WCM produced an expected profit of $171,119, more than the double than the target. Meanwhile, the RCMR produced $74,984, which is almost exactly as $75,000. That is a remarkable difference in accuracy. Statistically, the RCMR also achieved a perfect correlation of 1.000 with the control variable compared to only 0.962 for the WCM, confirming its superiority. Moving on to the Malaysian application. Now, why does this matter to us here in Malaysia? Malaysia is the world's second largest palm oil producer. When fresh fruit bunches are processed, they simultaneously produce crude palm oil and palm kernel oil, which are two distinct products from one single production process. This is one of the textbook examples of joint products. Companies like Sime Darby, FGV Holdings, and IOI Corporation all deal with joint cost allocation and profit planning decisions on a massive scale every single day. Based on Enge's findings, if these companies are using WCM method for their CVP analysis, which is the industry standard, they may be significantly miscalculating their break-even points and profit targets as well. In an industry contributing to 2.7% of the Malaysia's GDP, even a small miscalculation can translate into millions of ringgit in poor decisions. This is precisely why Enge's research is not just academically interesting, it has real practical implications for Malaysian industries. However, as a critical reviewer, I must also highlight the limitations of this study. Firstly, the data was collected from Nigerian companies, a confectionery and bakery firm. Whether these findings translate directly to a Malaysian manufacturing or plantation context has not been tested. Secondly, the study only examined 6 products from 2 companies. A broader studies across more industries and more products would strengthen the generalizability of these findings. Thirdly, while RCMR is statistically superior, its computation is more complex than WCM. Implementation in real-world companies would require training, and the system changes very fast, which carries its own costs. Despite these limitations, I believe that Enge's contribution is significant and timely. The evidence clearly shows that relying on WCM alone is risky for a company managing joint products. In conclusion, NE 2019 has made a compelling case that the current standard method for joint product profit planning is flawed and that a better alternative exists. For Malaysia's palm oil industry and beyond, adopting a more accurate CVP tools like the RCMR could mean the difference between sound financial decisions and costly miscalculations. Thank you.
Assalamualaikum and hi everyone. My name is Nur Ali Natasha bint Abu Hussein and my metric number is 313941. Today, I'll be discussing the critical evaluation and recommendation of joint products based on the article Joint Cost Evaluation Problem and Solution by Maria Silvia Avi 2023. Now, let's start with some of the main challenges of joint products. One of the biggest challenges is allocating joint costs accurately. According to Avi 2023, it is difficult to assign joint costs objectively to individual products because several products are produced together through the same production process before reaching the split-off point. Okay, for example, in the palm oil industry, fresh fruit bunches are processed to produce crude palm oil and palm kernel. Since both products come from the same process, it is not easy to determine exactly how much cost belong to each product. Another issue is that different cost allocation methods can produce different cost figures for the same product. For instance, a palm oil company might use the sales value method or the physical units method. If the sales value method is used, crude palm oil may receive a larger portion of the cost because it has a higher market value. However, if the physical units method is used, the costs are allocated based on the quantity produced. As a result, the cost assigned to each product can be quite different depending on the method chosen. This can lead to differing profitability results and make it harder for managers to identify the actual cost of each product. According to Avi 2023, these challenges can affect the accuracy of product cost evaluation and eventually influence management decisions. Now, let's look at how these challenges affect pricing and profit decisions. First, inaccurate cost allocation can lead to incorrect pricing decisions. If too much cost is allocated to a product, the company may set the selling price too high. On the other hand, if too little cost is allocated, the product may be sold at a lower price than it should be. Okay, for example, in the palm oil industry, if a large portion of joint cost is allocated to palm kernel, the company may increase its selling price. This could make the product less competitive in market. Besides pricing, joint cost allocation can also affect profit decisions. Different allocation methods may produce different profitability results. Sometimes, a product may appear less profitable simply because it has been assigned a higher share of joint costs. As a result, managers might make poor decisions such as reducing production of a product that is actually performing well or allocating resources inefficiently. That is why Avi 2023 emphasized that joint cost allocation is very important for production valuation, pricing decision, and profitability evaluation. Managers need to interpret cost information carefully before making business decisions. So, what can companies do to deal with these challenges? Based on Avi 2023, companies should choose a joint cost allocation method that best reflects the economic value of their products. Since different methods can produce different results, managers should compare several allocation methods before making important decisions. At the same time, managers should not rely on allocated costs only. They should also consider other factors such as market value, customer demand, and the company's overall business objective. In other words, cost information is important, but it should be combined with managerial judgment. By choosing the most suitable allocation method and considering both financial and non-financial factors, companies can make better pricing decisions, evaluate profitability more accurately, and improve overall business performance.